Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Protect and Grow with Chichagoland certified financial planner Tim Stearns of TJ Stearns Incorporated. Trust, respect, and results. TJ Stearns Incorporated focuses on comprehensive financial planning and benefits.
And welcome into the program. This is Protect and Grow Chichagoland Retirement with Chichagoland's resource for a common sense approach to planning for our financial and retirement futures. He is certified financial planner, CFP Tim Stearns. Tim, welcome back in.
Hey, Peter, thanks for having me.
We appreciate the time, Tim, and the guidance and perspective that you provide to savers and investors who, unfortunately, these days, Tim, are often confused, don't get the information or education, and are thrown in this complex, crazy financial world that we're in.
Right, 100%. And people are questioning what's going on with, the election, what's going on with, the COVID numbers and that type of thing in Chicagoland, and with that upheaval, the market doesn't like that stuff, and the market's been a little bit of a roller coaster. And we're just trying to answer people's questions. We're seeing them via Zoom. We do have people coming into the building. We're doing telephone calls. Anything we can do to help people, because people are very nervous. I have a lot of different prospects have said, I'm not sleeping at night because I don't know what's going on.
Yeah.
Especially if they're at their tail end where they're about to retire.
Yeah, right there in the last little bit is the critical crunch time. That's where we don't want to make mistakes, or even fresh early into retirement, Tim, can be a pretty critical time as well.
Right, and we call that the red zone in class. So when we're doing our classes, that's one of the things we talk about. And the years leading up to your retirement and the first couple of years that you're in retirement sets the tone. It really does, and people need to realize that.
Well, we are going to talk about one of the most critical factors for that retirement success today, which is taxes, and more specifically, how to control your tax bill in retirement. We can't do a whole lot about the market, but we can control how much we're exposed to it. Tim, likewise, we can't control tax policy as an individual, but we can control how that policy will impact and affect our retirement. And that's where I think people need that education, is that we do have control over how those unpredictable, uncontrollable factors actually affect and impact us. And so we'll talk about that today. We'll talk about keeping more of your money, and which in many cases is as effective as shooting for higher returns, but with far less risk. And certified financial planner Tim Stearns will lead the way in the conversation here about how to build more tax-free income for ourselves in retirement. If you've got questions, if you would like to talk over conversions or contributions or how to keep more of your money in retirement, pick up the phone and give a call, 800-640-2256. That's 800-640-2256. You can visit online, tjstearns.com, tjstearns.com. Lots of information and resources and reports available there as well. But Tim, the best opportunity, I'll say the best, one of the best opportunities for us to build for more tax-advantaged income in retirement is the Roth IRA. And in previous shows, we've gone over some of the distinct advantages that a Roth presents us over maybe some other options. But recap for us, and then let's get into some strategies to get more into the Roth.
Well, the Roth has been around quite a while. I still don't think everyone kind of understands the gravity of what it's capable of doing. The growth is tax-free. Your income is going to be tax-free when you finally take it out. The inheritance is tax-free, which is key with the Secure Act, and we'll talk about that a little bit later in the show. You can withdraw initial contributions without penalty before 59.5. That's something you cannot do in an IRA.
Good for people who might be retiring early or thinking about retiring before 59.5.
Right. And more importantly, because there are no RMDs, it plays right into why, the Secure Act took away a lot of different things. And people, I've found that most people don't even know what the Secure Act is. And so, some of the stuff we talk about in class and is what is it? Well, for example, There's no more stretch IRA. The RMDs got moved to 72. No more age limit for IRA. There never was one for Roth. But my point is that, I had a teacher when I got my education at DePaul that would talk about how if the government gave you something in your left pocket, they took it away from your right pocket.
Mm-hmm.
And it's so true.
And it's usually the bold print is where they tell you what they're giving you, and the fine print is where they're taking something away.
Right. And I don't think people realize a stretch IRA was really powerful because you could take out money at your age. My mom is going to be 91. Now, if God forbid something happens to her, I have to take her money out at that age level while I'm still working. My wife and I don't want that money right now. And what we'd want to do is take out smaller amounts based on our age. Instead, I have to take money out at a 91-year-old's rate, which is not good. And the other thing I will talk about, one other thing that we've noticed in class, no one seems to understand what IRMA is. And IRMA is kind of a new thing a couple of years ago that Medicare started. And basically, it's income-related monthly adjustment amount. Now, what does that mean in layman's terms? They look back 2 years ago to your tax return to see what you were earning. And based on that is what your bill will be for Medicare. So if I'm the normal saver in the United States, I might have $21,000 and I'm just going to have Social Security coming in. I'm living paycheck to paycheck, but it's coming from Social Security. IRMA probably won't affect me. Right. But let's say I'm that person that has a pension. I have a 401k that I've stuffed money in my whole life. Any income that comes in raises the amount of rate that Medicare will start to charge me. So we had one gentleman come in here the other day on open enrollment about a year ago, which we're coming up on open enrollment now. So if people have questions, we can answer them on that. He came in, he didn't have much money to his name, and his bill literally was a couple $100s. Fast forward that day, I met with a person who had come in to a lot of money from a beneficiary IRA, which of course he's going to have to take money out of. Plus, he had a nice 401k and a pension, and his bill was over $500 for just him. So think about it: if him and his wife are paying over $1,000 a month versus this other guy would be paying, him and his wife would be paying about $400. It doesn't seem fair, but back to my original point, that's what helps with a Roth. Because if I take money out of a Roth, that doesn't go to my income at all. Remember, it's income tax free. So the IRMA doesn't even apply to that. So I tell people all the time, if you get the chance, put money in a 403B Roth, a 401k Roth, and if you can, fund a Roth. It's unfortunately the limits are small, 6,000. But back to, if you're over 50, it's over 7,000. But at the end of the day, there are some limits to a Roth. If you make over $139,000 as a single filer, you can't contribute to one. And if you make over $206,000 as a married couple, you cannot contribute to one. Yeah. But if you have a 401k Roth, the sky's the limit. You can put right now $19,500 away.
So again, it's really about control. It's about keeping as much of our money as possible. It's about efficiency with our money. And there are some ancillary benefits with Medicare, the premiums that you'll pay there, with Social Security, because that's also potentially taxable to us. But there are, Tim, limits and limitations on this Roth IRA. And I think that is where a lot of the confusion lies. Whereas people maybe don't understand the difference between contributions and conversions. A contribution is if I'm getting paid, my work ethic, my employer's putting money in my hand, and saving for retirement is putting it in one of my pockets. That's a new contribution. I can only put in $6,000 or $7,000 a year, depending on if I'm younger than 50 or over 50. But a conversion, right, Tim, and only if I make under a certain amount can I even do that at all. But a conversion does not really have those limits or limitations. So that's probably where our biggest opportunity lies, correct?
Correct. The thing you have to be careful with is that as you convert from an IRA or 401k into a Roth, there are going to be taxes, right? So what we do in our class is we literally show them, right now taxes we say are, on sale. They're lower than they've been ever. And we show them that if you take out, let's say $40,000, where does that put you on a tax bracket? So there's some room left in the tank so you don't bump yourself up to the next tax bracket. We go through an exercise, and I think people really appreciate that. We've had a lot of people come in here to do that. It's easy. We can help them. We have a CPA on staff, so we're able to tell them what the true tax bill is going to be. But yeah, the conversion is great, especially there. Again, back to your point, there's no income limits.
Well, Tim, I'm sort of reminded of an old fairy tale when we talk about this, of the Billy Goat's Gruff. And if you remember this Brothers Grimm fairy tale, there were three goats, and they had to cross a bridge with a troll underneath it. And the way that they sort of tricked the troll is they all told him, just eat me when I'm fatter, eat me later when I'm fatter. And then the biggest goat knocked the troll off the bridge. It's kind of like we are the goats with our retirement accounts crossing that bridge, and we're making a deal with the IRS to come tax me when my account is fatter, except we don't have that final goat that's going to knock the IRS off the bridge. They're going to be there. They're going to remember that we made that deal with them, and they're going to tax us later when the account is fatter.
Right, 100%. The analogy we use in class is that you're kicking the can down the road. Basically, taxes are at all-time low. So this conversion is a great example. But, with taxes going up, if you're going to put money into anything, you should try to do it into a 401k Roth. If you're still working, do these conversions, that type of thing, and get some tax-free growth. And more importantly, tax-free as you do withdrawals as well.
Tax-free income in the future. That means you get to keep as much of your money as possible, all of it, because you've already prepaid that tax bill up front. So lots of benefits here. So let's talk, Tim, specifically about how to get money into this category of tax-free for our future. And ladies and gentlemen, again, a huge opportunity, a great moment to take advantage of that opportunity. Contact a certified financial planner to get specific guidance and recommendations on how you should be taking advantage of that opportunity. Give Tim Stearns a call, 800-640-2256. That's 800-640-2256, 800-640-2256. So Tim, the pros, you mentioned several: more control, get to keep more of our money, begin to grow tax-free, income tax-free. The drawback is that we have to pay taxes on it up front, but some of us can't even do that. We're income eliminated. So what are some of the strategies for those that might make too much or be over those limits?
Well, there's a backdoor conversion that you can do. So, if you have the same amount of, let's say, $7,000 available, you might be able to convert a significant amount from existing tax-deferred assets to make them tax-free into the future. That's one thing. Number two, and I like this a lot, life insurance. Believe it or not, there's life insurance with cash value to it that also comes with what? Long-term care benefits. If you can't do 2 of your assisted daily living benefits, then you are able to pull down on that account to pay for long-term care. So, they're not the only way to build tax-free income. Roths, that is, and inheritance. Life insurance definitely is. The thing I like about life insurance right now is that there are 3 ways to get money. Number one, you might be getting it because unfortunately you passed away. That's a death benefit, tax-free. Okay. Then there's also a cash value to it. If you pull money out of that, it's a loan against the policy. It is tax-free as well. And then lastly, if you can't do 2 of your ADLs, assistant daily living benefits, then you are able to pull down it again there for the fact that, it's a loan against the policy. The last one is the employer plan loophole. Even if we're making a significant income and are eliminated from making Roth IRA contributions, our employee offers a Roth 401k, we still could take advantage of that.
And the limits, in fact, are significantly higher in that employer-sponsored plan. So I know that some employees that might not be able to make Roth IRA contributions, Tim, actually go to their employer and ask, do we have a Roth 401k available, or can we if we don't?
Right. A great example is you can put $19,500, and then if I'm over 50, you can put even another $6,000. That's outstanding. Your profit sharing would still be what it is. It's going to be taxable when you pull it out, but at least you put almost $25,000 away into a Roth if you're over 50. into a Roth 401k.
So Tim, the company might be nice enough to offer us a match, but they're not going to be nice enough to pay our taxes for us on that money, most likely.
I would agree. Yes, they would
Yeah.
not do that.
All right. So if you have hit your limits or are income eliminated from making Roth IRA contributions, backdoor conversions, life insurance may be an option, and then the employer plan loophole. 3 ways that you can still get money growing for yourself tax-free for your future. Now, Tim, if we do have the opportunity to make contributions, we want to make as much as possible, take full advantage where we have those. So what are some of the strategies that you help people identify to maximize the contributions that they can make?
Well, there's about 5 to 6 of them that I like to talk about with our clients. Number one, married, double it up. If you're married, you can make contributions for each spouse, even if only one of you has earned income. So instead of $6,000, you get up to $12,000 in new contributions. All right. Number 2, use your return. When you're getting a tax return, consider contributing it right back to a Roth IRA. It can make a great jumpstart or an extra boost. Number 3, contributing over the match. If you're contributing to your company's plan over the amount that is matched, sit down and speak with a financial and or tax advisor. Again, we have a CPA here, plus I'm a certified financial planner, about the benefits, disadvantages, and long-term results of repositioning non-matched contributions to a Roth IRA.
So Tim, kind of an order of operations there. Capture the match first, obviously, but
always
anything over and above the match, we really maybe need to make some other considerations about where to place that.
Right. And then my number 4 is, Roth at work. If your company offers a 401k, they may offer you the ability to decide to pay your taxes on your contributions as they are made in a Roth 401k. This will lower your net pay for the time being, but as you will be taxed on the contributions, but the Roth 401k's higher contributions amounts that the IRAs allow, more than the IRAs allow, your company will not pay taxes on their match portion. This will remain tax deferred, like we had talked about.
Right. But that's a strategy for anybody, not just those that are over limits and limitations.
Absolutely.
If there's a Roth at work, let's take advantage here.
Right. And then number 5, working when you're over age 70 to 72, you can still make Roth IRA contributions regardless of your age. And then number 6, doubling up. If you can, take advantage of both workplace plans and IRAs.
So Tim, just a little bit of math here, because I was adding this up. If we've got a married couple and we're doubling up the contributions for each spouse, and then we're contributing for 2 tax years, like we can do between January and April, and then we're also maxing out workplace plans. Let's say we got a windfall, we got an inheritance, or we're just serious about trying to catch up for retirement. That's about $80,000 that we could get into accounts that are growing tax-free for our financial future in a single given year.
Right. It's a great opportunity, and that's something we talk to people about. My wife and I always talked about how, we gave till it hurts. If we couldn't feed our 3 sons or pay the mortgage, we'd step back our contributions. Well, thankfully, we've never had that problem. And, the power of compounding does wonderful things. And, 8th wonder of the world, according to Einstein.
Well, there are also strategies for conversions. And Tim, because the American public has done a good job in saving, but we've been told and taught to save in tax deferred accounts, we've built up large amounts that has yet to be taxed. This could be where the greatest target is for future taxes, future tax increases, and where probably the greatest opportunity is for today's saver and investor. So let's talk about some of those strategies for making conversions, Tim.
Okay. So there's, like we had talked about earlier, there's maximizing your tax bracket. This is a very proactive planning technique to utilize any available room between your current income and the next highest potential tax bracket, and converting enough tax postponed money, IRA, to tax-free money, Roth, to get us right under the next highest tax bracket. We do this in class all the time, to everyone's wonderment. They love watching us do it. So, and I don't think people think about that there's room still in the bucket, using that you have 26,000 if you're a married couple, in exemptions that, that's going to help with your tax bracket, amongst other things. Number two, strategy for conversion, use your return. Are you getting a return? Consider using it as a mean for additional conversion. So for example, if you're in a 20% tax bracket and expecting a $4,000 refund check, this may be a great way to move an additional $20,000 from tax postponed accounts to tax-free accounts. That's one of the ways that we'll tell people to help themselves, if they're getting money back. Number three, using extra savings. Anytime you have extra money to save to a Roth, to save in general, Roth should be in the conversation, but especially after 50. When you have the ability to make catch-up contributions, consider this opportunity carefully and how to best position extra retirement dollars for maximum effectiveness.
Because again, if you've paid your taxes up front on your retirement nest egg and you get to keep more of it once you get there, Tim, that's equivalent to having saved more money for yourself.
Right, exactly, 100%. The other one that we've looked at, number four, is using your RMD. Your required minimum distribution. Some retirement account investors find that they don't need all the income that the IRS requires them to withdraw. So consider using your net required minimum distribution to proactively convert more of your IRA. This can be beneficial for future income or an inheritance to your family.
Now, Tim, just to clarify, you can't convert the RMD. What you're saying is take the RMD, pay the tax, and then you've got some money in your hand that you could look at converting even more tax-deferred dollars.
That is correct. That's exactly what I meant. The other one is use Social Security. Occasionally there's a case where, Social Security is claimed but not really needed. You may consider using this to pay for conversions or make new Roth IRA contributions. And then lastly, and this is a great one, take advantage of the downturns. Like in March, when downturns do happen, there may be an opportunity in that crisis to proactively pay taxes on a lower amount. It's definitely a great way to look at things. I mean, you have to be proactive about these things. So we have many different strategies for conversions, and I tell people, give us a call. We'll help you.
Now, these were the kind of things, Tim, that you were proactively looking for. We're not looking forward to any kind of downturn in the market, but when they do occur, and we will probably see downturns again into the future, that's the type of opportunity that even though we're not wishing for a downturn, there are qualities about a downturn that we can take advantage of. And this is something that for your clients, you're watching for proactively.
Right. And I mean, just to use the old analogy, if you're given lemons, make lemonade, right? So,
there you go.
Unfortunately, it's make something good out of something bad, and that's another way that we tell people. And then you get the rise in the Roth when the market comes back. I mean, it's a win-win.
Now, Tim, if we've got an account, let's say it's a tax-deferred account, $100,000, we want to convert that over to a Roth account. So a traditional IRA, $100,000, we want to convert it over to a Roth. Should we use money inside the IRA to pay that tax bill on that conversion?
No. I always tell people that we have a lot of different people who say, "Oh, I'm just going to use the money in there." The whole idea was that you put the money away to leave it alone, not to pay taxes with it. So use all that money to convert, and then you have to. I mean, unfortunately, you're going to have savings or something else to pay for the conversion. That I tell people, get money outside of what you're doing, not to use the money that you're converting. That makes no sense.
Well, Tim, this really comes down to a lot of the assumptions that are made in planning and what the future of not only taxation looks like, but what the future of our income looks like. Because even if taxes stay the same, if inflation occurs and our need for income goes up, we could be, in effect, paying higher taxes. And so we really need to look at all of those assumptions that are made, because a lot of people are planning in a way, making assumptions that if things don't turn out just right for them into the future, they'll have less money than they thought they were going to have. And for the vast majority of Americans who are deferring taxation, that's sort of what it's looking like for us right now.
Right. So, I mean, we always tell people, try to get ahead of it. Don't be reactionary. You want to make sure that you're actually planning ahead for taxes and, doing these conversions and that type of thing, when you can. I wouldn't do it on your own. I would call, a financial planner, a certified financial planner. I would call, someone who had a CPA on staff, and make sure that you're going to do it right. You can really hurt yourself if you do it the wrong way. You can pay more in taxes than you really need to. And I'm all about paying the fair amount of taxes, but why not try to, make sure that you're not paying more?
Well, it's always said that money can't buy love, happiness, or time. But essentially, Tim, if we have paid off our tax bill early and we're looking at how long we can make our money last,
yeah,
because we don't have to pay those taxes out of our nest egg, we can make that money last that much longer for ourselves in retirement, and probably be a little bit more content with knowing what that situation looks like into the future as well. So again, ladies and gentlemen, strategies are abundant. They need to be proceeded with caution, however, and certified financial planner Tim Stearns can help you identify which strategies may be right for you to get tax-free money building for yourself, for your financial future. Pick up the phone and give TJ Stearns and Tim Stearns, certified financial planner, a call. 800-640-2256. That's 800-640-2256. 800-640-2256. And Tim, looking at the tax situation, that's all part of the income planning process, part of the full complimentary review and analysis that you do there at TJ Stearns Inc.
Always. I think a lot of people, we're doing an income allocation plan, which again, I'd say 95% of Americans don't have. And then the little bit that do, it's some spreadsheet that they came up with that they didn't really take into account different things, including taxes. So we make sure when we ask somebody, what do you need to live on? Probably about $120,000. Well, is that net or is that gross? I didn't think of it. And then they look at each other and they're not even positive what the amount is. So we make them go back to the drawing board and make a budget that we can see what the net amount is. Because if we're pulling money out of qualified plans that maybe they weren't able to do Roths back in the day, then we need to make sure that we understand how much in tax, what is the tax bill going to be and how much are they actually taking home.
Well, if you'd like to go through that income planning process, including looking at your tax scenario into the future and trying to strategize to keep as much of your money as possible, pick up the phone, give certified financial planner Tim Stearns a call. 800-640-2256. That's 800-640-2256. Tim, we always appreciate the time, the guidance that you provide to Chicagoland area savers and investors.
Thanks again for having me, Pete.
Tune into Chicagoland Certified Financial Planner Tim Stearns' full radio program on 890 WLS every Sunday at 11 a.m. and visit tjstearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. The information presented on this program is provided for informational purposes only without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.